Almost every charting platform comes with a host of trading indicators that, for those who engage in technical analysis, they may find them useful. You can simply apply any of them to your chart, and a calculation takes place that takes into account past price, current price, and depending on the market, volume. And there are different types of technical indicators that do different things. You have trend direction, momentum or the lack of momentum in the market, volatility for profit potential, like is the market really moving, and volume to see how popular the market is with other traders. So the issue becomes using the same type of indicators on the chart, which basically just gives you the same information. And while this might be just explained away as looking for trade confirmation, what it really does, it gives you conflicting information as well as more information that you have to process. A simple example is having several trend indicators that show you the short-term, the medium-term trend, and the longer-term trend. And from a multiple time frame perspective, this might appear logical, but many traders, I bet you can attest to seeing a perfectly valid setup negated because of a trend conflict, and then just watching the trade play itself out to full profit. Check this chart out here. The evolution of price, the lag of the moving average indicators can give you conflicting signals. Price below a long-term average means short. Price above the medium term means long. Price above the short term would mean long. So the blue lines indicate trading opportunities which would have either been skipped or have you on the wrong side of the market if you relied on the trading indicators for your decision-making process. In the bottom here, it shows a consolidation with higher lows and momentum breaking to the upside. The short-term moving average has price entwined with it, which tells you that price right now is in consolidation. The longer-term moving averages have you looking for shorts. Playing the consolidation price pattern and using price action would give you a long trade entry. And the main drawback with indicators is that since they're derived from price, they have to lag price. Now, a trend indicator can be a pretty useful addition to your day trading or your swing trading, but be really careful of confusing a relatively simple trend concept. And here's a quick question for you. Trading can often involve quick decisions. So would your trading be better served by simple or complex information gathering? Now, useful is subjective, but I think there are general guidelines that you can use when you're seeking out useful indicators for your trading. And one simple guideline is to choose one trend indicator, like a moving average, and one momentum trading indicator, such as the stochastics or the RSI. And you must know what edge you're trying to exploit before you're deciding on which trading indicators you're going to use. And to add to that, you must also know how the indicator works, what calculation it does, and what does that mean in terms of your trading decisions. For example, the idea that moving averages actually provide support and resistance is a myth. Now, looking at this chart again, when the moving average connects with price, what you're really seeing is the average price not being as large as recent history, and the moving average just catches up to price. So do trading indicators even work? Well, it all depends on how they are put together in the context of a trading plan. Some of the most used technical indicators, such as averages, MACDs, and CCI, they work in the sense that they do their job in calculating information. The power of the indicator, it lies in how you interpret the information as part of your overall trading plan. So don't be sold on those holy grail trading indicators that marketers are flooding your inbox with. Proper usage of basic indicators against a well-tested trading plan through your back testing, your forward testing, and through demo trading is a pretty good route to take. And all the systems that we offer at Netpicks not only come with tested trade plans, but they also hammer home that you must prove any trading system or trading indicator to yourself. And now there is a downside when you're searching for indicators that work for your style of trading and your plan. Many trading systems are sold using standard indicators that have been fine-tuned to give you the best results on past data. They package it up and they sell it without taking into account changes in the market behavior. And the backbone of many trading systems are mechanical in the sense that if A happens, you do B. And there's nothing wrong with optimizing to take into account current market realities, but your approach and your mindset in doing so can either have you being realistic or over-optimizing out of the realm of complete reality. And one way you might choose to not fall into the over-optimizing trap is just use the standard settings for all trading indicators. This ensures that you're not zeroing in on the most effective setting for the market of today without regard for tomorrow. And I've used many indicators over the past, and I still look at a few, although they are never the actual reason for taking a trade. So I want to take a look at 3 indicators and how they can apply to your own trading. The RSI, we're going to use that to measure the momentum of a market. Moving average, it can be used for trend or to see overextended markets primed for pullbacks or mean reversions. And channels, markets move in a rhythm, and any move that breaks that rhythm can be cause for attention. Now, what I want you to take notice of here with the RSI is when it breaks either the 70 or the 30 level. This is not to take a reversal trade in overbought or oversold territory. Markets have a way of staying in those conditions long after a trading indicator calls the condition. The moving average here, it's not for trend. What I want you to note is how far price is moving away from the indicator, hugs the indicator, or bounces from the indicator. And following an objective means to draw your trend lines, simply copy and paste your first line to the other side of price. Markets move in a rhythm, and anything outside of that rhythm will cause a break of a trend line. Now, this can indicate that something new is coming to the market, and we could be seeing a trading opportunity. Now, first thing I want to tell you is how not to use these indicators. They are not going to be your ultimate decision-making tool, whether or not to enter a trade. For that, let price action dictate, and you may find that this free candlestick reversal PDF pretty useful in putting together a trading plan. You'll also want to determine what your trade trigger will be. The RSI is going to be used to show momentum. So if price breaks the 70 or the 30 level, we're going to be on alert for a trading setup in the same direction as the break. The moving average is going to be used for a general area, a wide zone, where we're going to look for price to resume after a pullback. And the channels can be used for trade direction, signify change of trend, and depending on the size of the channel, used in the same manner as the RSI. Now here we have number 1. The RSI is oversold, which lets us trade short. Price is far from the upper line and the moving average. All we get are entries via breaks of consolidations. At number 2, price leaves the oversold area. Now that's not a trading condition, it's just an observation. And we get a break of the upper trend line. Price eventually gets momentum and pulls back to a zone of the moving average. We are on alert for shorts, but consolidation breaks to the upside. Now this is a trade that you could position for due to the something new, which is a break of the channel and the momentum in price. And number 3, the RSI hits 70. Price pulls back to the area around the moving average after breaking the low of the channel. Now after breakouts, we generally see retests, and we're looking for longs due to the price trend. The blue line is a trend line that we can use for entry if it's broken with momentum. Price breaks back to the upside with momentum. Number 4, the RSI pulls back, breaks to the upside. At number 5, price has broken the longer term channel and has formed a downsloping channel. The RSI had hit 70 and we're looking for upside. Price breaks the channel, the consolidation, and we have upside momentum. So you can see that any trading decision is made from price action. The indicators frame the market, so we have some structure to work with. We're using the RSI to show us a market that has some momentum. We're using the moving average as a general location for some trades. We use the trading channels for trend. We monitor breaks for momentum and can use the breakout pullback sequence to position in a trade. So as you can see, this gives you 3 trading indicators you can use in a manner that still allows price action to determine your trading. And you may eventually stop using the RSI and simply measure momentum by how far price is from the moving average. The moving average might just disappear from your charts, and you'll use the channels, tops, and bottoms as general zones for price to react at. Every trader is going to find something that speaks to them, and it's going to allow them to find a particular technical trading indicator useful. And whatever you find, the key is to be consistent with it and try to not overload your charts and yourself with information. Simple is usually best. And just keep this in mind here. Determine your trend, determine the setup, determine the trigger, and manage risk.